Starbucks is probably the most recognizable coffee shop on this planet. In today's video, we're going to evaluate whether or not buying them at today's price could make sense. Let's look at their numbers first. They made a revenue of $37 billion in the last year with a net income of $1.86 billion, which gives them a profit margin of around 5%, a bit lower than their historical margins. They had a bit of pressure with their income, and they're currently sitting at around $99 a share, which gives them a hefty PE of 60. So investors are paying as much for the company as for their coffees. Looking at a bear case, we're going to assume some numbers for the next 5 years. And in a bear case, we're going to assume that they really struggle with getting more sales, that maybe their brand declines a little bit, but they're going to at least move with around inflation. You know what? Let's give them a little bit more than inflation for a bear case, and that their profit margin continues to struggle on their lower historical side. They have been buying back, reducing their share count a little bit over the last couple of years. So we're going to assume that a small share decrease continues to happen. And valuating Starbucks is a bit difficult because the stock has a tendency to be on the higher side, as we can see. So it's a bit difficult to evaluate where they're going to sit. But for these numbers that don't look too great, I think a PE of 24 would even be a bit too high. But assuming that people would still spend more for this premium company, I think it is justified. This would take the stock to a future price of $63 a share, which bought at today's price would mean a negative return of 8.58% annualized if these assumptions were to come true. But in contrast, let's of course look at an opposite bull case, same 5 years, but this time a higher revenue growth of 7% annualized, which would be pretty decent for such a well-established company, a higher profit margin of 10% and still a small share reduction, and a hefty premium PE of 32. This would take the stock price to $162 a share, which bought at today's price would mean an annualized return of 10.3%. And if we combine these two cases into an average case, this would almost keep the stock flat, which with an annualized return of 2.6%. So for me personally, these numbers don't look too promising. Again, a company that's currently selling for a PE of 60 needs to achieve very high future growth numbers in order to justify its today's price. Maybe I'm missing something that could justify these numbers. So if you guys know anything about it, please let me know down in the comments. But for me right now, the company is a hard pass. The stock will need to drop much further, or the growth story will need to spark way higher again in order to justify it buying it for me. But that's just what I'm thinking. Thank you for watching, and I will see you next one. Bye.